Welcome back everyone to our quarterly on credit video. Thanks for joining us today. In this edition, we'll briefly talk about the resilience in US growth and employment, positive third quarter earnings trends, and how elevated policy uncertainty after the US election may affect both fixed income markets and our portfolios. Now I'll shift to share three very high-level macro thoughts. First, US economic activity and employment have shown positive momentum since August, which, along with some policy uncertainty about tariffs and immigration, are pushing Treasury yields higher. Second, Trump has promised deregulation, lower taxes, as well as restrictions on imports and immigration. The impact of such policies on growth and inflation may vary widely depending on their magnitude and timing, which is currently leading investors to ask for higher yields as an insurance strategy. And finally, third, Trump's announcement of some controversial candidates for his cabinet signals that he's willing to take a sharp policy shift. So let me ask Marcelo, within our universe of US and LATAM corporate credits, what are you thinking about in terms of drivers for next year?
As you well said, Alejandro, uncertainties regarding the exact policies of the upcoming Trump administration are driving yields higher. Just to share some numbers, the 10-year US Treasury is currently trading around 4.4%. In our last on credit, we were at 3.8%. Interestingly, 3.8% was also about the level we started the year. What are the consequences of higher US Treasuries? Well, we now have higher yields in US and Latin American credit. I am kind of a numbers guy, as you can see, so let's again share a few other numbers here. US investment grade is currently yielding 5.2%. US high yield is around 7.5%. Emerging market sovereigns are at 7.8% and emerging market corporates are at 6.3%. These are elevated levels, especially if we get a scenario in which inflation does not increase much from the current levels of around 3%. We have been noticing these more compelling yields when we look at individual bonds. When we published our last coverage and top picks report, we upgraded several bonds. Investors can again find very solid investment grade companies yielding 5% or more, including in developed markets. That was not the case a few months ago. While yields can move even higher, we think investors have again a very good window of opportunity to invest in high quality credits, locking in these elevated rates.
So I'm going to basically share some three main points on earnings trends and market impact. First, about 75% of companies showed positive earnings per share, surprising in the third quarter. Earnings are estimated to be somewhere between 5 and 5.5, likely completing a fifth consecutive quarter of growth, which is very positive. Second, although resilient economic growth and employment in the US point to sustained earnings growth into next year, there's clearly a risk that policy uncertainty could push Treasury yields higher, which if sustained would clearly erode performance for both credit and equity markets. And third, depending on how Trump appoints as key economic advisors and how aggressive any approved legislation turns out to be, the Fed may have to limit its planned rate cuts. Marcelo, how are you planning to manage your portfolio in terms of credit decisions regarding all the policy uncertainty that you have given the election?
Generally speaking, we're constructive, primarily because of the higher yield levels in credit that I mentioned. The one metric that gives us some pause is spreads, which have been tight across the board in credit. However, as you mentioned, Alejandro, credit fundamentals remain very strong, which could sustain tight spreads for some time. In fact, we are starting to see the first 2025 outlooks being published, most of which point to lower default rates next year. The way we are playing this market backdrop is by slightly increasing our duration, mostly through investment grade and sovereign bonds. We think the 5 to 10 years maturity bucket in US investment grade is attractive, precisely to lock in higher yields in top quality companies. We also like higher yielding sovereign bonds, which are trading at compelling levels in our view. In terms of sectors, among the names we follow, we continue to like financials and basic materials in both developed and emerging markets. In developed markets, we also like the communication sector. The one sector we are a bit more cautious on in emerging markets is the non-discretionary consumer sector. But credit fundamentals for companies in this sector that we follow have been gradually improving as well, and we are less concerned than earlier this year. As a reminder, we have our Market Monitor report, which share our views on a weekly basis. Let's see what happens in the coming months. As of now, we have a very interesting combination of higher yields, tighter spreads, and good credit fundamentals. We will certainly have interesting financial markets in the weeks ahead of us.
Great insights. Thanks so much, Marcelo, for the caller. Thanks everyone for joining us today and throughout 2024, and it's been a pleasure to share our thoughts with you.
This discussion is intended for informational purposes only. This is not investment research or investment advice, and no recommendation or financial advice is being given. This discussion does not take into account individual investment objectives, financial condition, or investor needs. The views and opinions expressed in this discussion may differ from the views and opinions of other departments or divisions of Itaú and its affiliates.